Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Tuesday, April 21st, and we're seeing some notable market dynamics today, with tech leadership transitions making headlines and geopolitical tensions creating interesting crosscurrents. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert.
Well, the biggest story dominating conversations is Apple's leadership transition and what it means for their AI strategy. John Ternus is stepping into the CEO role post Tim Cook, and the pressure is on to fix Apple's AI positioning. Multiple headlines are calling this his defining challenge, and honestly, it's warranted. Apple has been playing catch-up in the AI race, while competitors have been more aggressive. The market's going to be watching closely how Ternus articulates his vision, especially with AI becoming the central narrative for tech valuations. Beyond Apple, we're seeing geopolitical tensions creating headwinds. German investor morale just sank to a 3-year low on Iran war fears, according to ZEW data, and Middle East strains are weighing on European markets particularly hard. The interesting dynamic here is that US markets are showing more resilience, with stocks bouncing from March lows despite analysts noting the rally has weak building blocks underneath.
That's a significant point about market resilience versus underlying fundamentals. What does this mean for traders and investors right now?
The key takeaway is selectivity. We're in an environment where headline indices might look healthy, but the breadth is concerning. When strategists talk about weak building blocks in a rally, they're usually pointing to narrow leadership and deteriorating participation. That's a yellow flag, not necessarily a red flag, but it means you can't just buy the index and expect smooth sailing. On the corporate side, we're seeing mixed signals. United Health topped estimates and hiked their profit outlook, showing they're managing high medical costs effectively. GE's profit beat by a wide margin, and Equifax posted their fastest revenue growth since 2021, driven by mortgages. But here's the thing. These are individual company stories, not broad sector strength for traders. This means focusing on company-specific catalysts and earnings quality rather than riding momentum. The geopolitical situation adds another layer. Oil prices are actually dropping despite Iran tensions, which UBS says resembles the first Gulf War scenario. That's creating opportunities in energy-sensitive sectors, if you believe the de-escalation narrative.
So we're looking at a market that requires more active management than passive exposure. How are the major indices positioned technically?
Looking at the technicals, the S&P 500 is holding above key support levels from the March lows, but we're seeing resistance around recent highs. JP Morgan has a blue sky scenario calling for 8,000 by year-end, but that requires everything going right: perfect Fed policy, earnings acceleration, and geopolitical calm. The Nasdaq is showing relative strength thanks to the AI narrative, but the Apple leadership question creates uncertainty for one of the index's heaviest weights. The Dow is benefiting from those strong industrial earnings like GE, but it's more vulnerable to geopolitical risk given its exposure to multinationals. My take is we're in a consolidation phase where the market is digesting the March rally and waiting for clearer catalysts. The technical picture suggests traders should be taking profits on extended positions and waiting for better risk-reward setups rather than chasing.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like?
Thanks, Robert. Today we're getting retail sales data, and this is a high volatility release that really matters for understanding consumer spending patterns. The most recent reading from April 21st came in at 59.24, against a forecast of 1.4% and a previous reading of 0.6%. Looking at the recent history, we saw 0.6% in April, 0.2% in March, and 0.6% back in January. This data is critical because consumer spending drives about 70% of U.S. economic activity, and it directly impacts both consumer discretionary and consumer staples sectors. The trajectory we're seeing suggests consumers are still spending, but the pace is moderating from earlier in the year. This has implications for Fed policy because strong retail sales could keep inflationary pressures alive, while weakening sales might give the Fed more room to pause or even consider cuts later in the year. The market's going to be parsing this data carefully alongside what we're hearing from retailers about inventory levels and promotional activity.
And what's coming up later this week that we should be watching?
Thursday, April 23rd, we're getting initial jobless claims with a forecast of 212K compared to the previous 207K. This will give us a read on labor market stability. Then on Friday, April 24th, we have two important sentiment indicators hitting at the same time. The Consumer Confidence Index forecast is 47.6, down from 53.3 previously, and the University of Michigan Consumer Sentiment is also forecasted at 47.6, down from that same 53.3 reading. Both of these indicators showing expected declines is significant because consumer sentiment often leads consumer spending by a few months. If confidence is deteriorating, it suggests households are becoming more cautious about their financial situations, which could translate into softer retail sales down the road. The combination of these releases will paint a picture of whether the consumer, who's been the backbone of this economy, is starting to crack under the weight of still elevated prices and borrowing costs.
Those sentiment numbers are definitely worth monitoring closely. Lizzie, let's shift to our stock of the day. We're looking at Brookfield Asset Management, ticker BAM. What's your analysis?
Brookfield Asset Management is one of the world's largest alternative asset managers, with about $1 trillion in assets under management across real estate, renewable power, infrastructure, private equity, and credit. They just completed a $1 billion senior note offering with series maturing in 2031 and 2036, which strengthens their balance sheet and gives them capital to deploy. The stock has shown recent strength, up 5.8% over the past week, and news sentiment is bullish, with articles recommending it as a quality long-term hold suitable even for beginner investors. Here's where it gets interesting though. Despite the positive fundamental news, the technical analysis shows an avoid bias with an entry score of -55 out of 100. That's a significant disconnect. The company's business model is solid. They generate stable management fees from that massive AUM base regardless of market conditions. Plus, they earn carried interest when investments perform well. With alternatives becoming a larger part of institutional portfolios, Brookfield is well positioned for secular growth.
That disconnect between fundamentals and technicals is intriguing. What's driving that technical weakness?
The technical signals suggest the recent rally may have gotten ahead of itself, creating unfavourable entry conditions even though the story remains intact. We've got earnings coming up on May 8th, just 16 days away, and there's no beat probability data available, which means results could create volatility in either direction. The risks here are interest rate sensitivity, particularly for their real estate and infrastructure assets, and the fact that carried interest can be lumpy and volatile depending on exit timing. The $1 billion in fresh capital is a positive because it shows market confidence in their creditworthiness and gives them dry powder for opportunistic investments. Looking at opportunities versus risks, the opportunities include that secular growth trend in alternatives, their scale advantages with $1 trillion in AUM, diversification across asset classes, and stable fee-based revenue. The risks are that technical weakness suggesting near-term consolidation, potential valuation compression after recent gains, and earnings uncertainty with results just over 2 weeks away.
So what's your take? Is this a buy the dip opportunity or wait and see?
Given the circumstances, I'd say wait and see for now. The -55 entry score and avoid technical bias are telling you the risk-reward isn't favourable at current levels. With earnings in 16 days and no clear visibility on results, you're essentially gambling on a catalyst you can't predict. For long-term investors with multi-year time horizons who believe in the alternative asset thesis, accumulating on weakness makes sense, but I'd want to see a better technical setup first. If the stock pulls back 10 to 15% and finds support, that could be your entry point. Short-term traders should definitely respect the technical signals and stay on the sidelines. The conflicting signals, bullish news versus bearish technicals, usually mean the market needs time to digest and find direction. I'd put this in the watch list category rather than the buy now category. The company's fundamentals are strong enough that it'll likely present a better opportunity, just not today.
That's a measured approach. Let's move to crypto. Lizzie, what are the latest trends you're seeing in the crypto markets for the week ahead?
Bitcoin is showing bullish momentum with some caution warranted. The big story is MicroStrategy's strategy purchasing 34,164 Bitcoin for $2.5 billion, bringing their total holdings above 800,000 BTC. That's more than BlackRock's IBTF. Now Bitcoin reclaimed the 75 to 76k levels, and technical metrics are showing bull signals targeting 78k as the key resistance to break. The interesting catalyst is geopolitical. Iran's ceasefire talks and reduced war threats are supporting risk on sentiment across markets. Tether's 8.2% stake in Bitcoin mining platform, Ant Alpha, shows continued institutional confidence. For the week ahead, I'm bullish with a target of 78k, but traders need to watch that level carefully because whales have been offloading near 75k, which could create resistance. Support is solid at 75k, with 70k as critical. Lower support. One risk factor is MicroStrategy's MSTR stock slipping below $100, which some analysts say could pressure Bitcoin below 70k.
And what about Ethereum and Solana?
Ethereum is cautiously bullish. A major whale just opened 90 million in long positions, targeting $3,200, and BitMine bought 101,627 ETH, worth over 230 million in their largest weekly purchase. Singapore's OCBC launched a tokenized gold fund on Ethereum and Solana, showing real-world institutional adoption. The target is 3,200 based on whale positioning, but there are concerns. Arbitrum froze 71 million in ETH connected to the Kelp DAO exploit, and there's been a $14 billion exodus from DeFi following that hack. That's a significant risk factor that could weigh on sentiment. For Solana, I'm neutral to bullish. The OCBC selection, alongside Ethereum for that tokenized gold fund, is institutional validation, and Sol is maintaining stability amid broader crypto gains. It's likely to follow Bitcoin and Ethereum's lead. So if they push higher, Solana should benefit with 10 to 15% gains possible. Overall, institutional investment in Bitcoin remains strong with Strategy's aggressive accumulation and Tether's mining investments, while retail is showing renewed interest according to Deutsche Bank data, saying US crypto adoption is rebounding.
Solid overview of the crypto landscape. Well, that wraps up today's Morning Bell. Remember, do your own research and consult with financial advisors before making investment decisions. The markets are showing us that selectivity and patience are key in this environment. If you found today's discussion valuable, please subscribe to the Morning Bell and join us tomorrow for more market insights. I'm Robert. Thanks for listening.